Good morning. These are the things that matter most in Europe's market today. Washington is preparing a tougher financial offensive against Iran. Oil is moving as traders price sanctions and ship seizure threats. AI infrastructure is running into power and cybersecurity limits. And Asia's tech tape is warning that funding the AI build-out is not free. The central question is simple. Can Europe stay selectively constructive if energy risk, grid bottlenecks, and AI funding discipline all test margins at the same time? Start with Iran and oil. CNBC reported that the United States is preparing what it called its greatest financial offensive against Iran, while Tehran threatened ship seizures. CNBC also reported that oil prices fell as investors waited for the toughest U.S. sanctions on Iran. For Europe, that combination is not just about the direction of crude this hour. It is a margin map. The cleaner side is Shell, Total Energies, and BP if energy cash flow and supply security are rewarded. Pressure sits with Lufthansa, IAG, and chemicals where fuel or feedstock costs can move faster than pricing power. For private investors, the useful filter is transmission. If oil falls on sanction timing, Europe may breathe. If shipping risk returns, the same story can quickly become an inflation and margin tax. Second, AI demand is still strong, but the bottleneck has changed. CNBC reported that what is bogging down the data center trade has nothing to do with demand. CNBC also reported that a small UK power generator was shut down after a cyber attack linked to Iran, according to the Telegraph. This is today's underappreciated mechanism for Europe, electricity security. AI capacity is valuable only if power generation, grid connection, cooling, and cyber resilience can keep up. The cleaner side is Schneider Electric, Siemens Energy, and Legrand if grid equipment and electrification orders keep arriving. Pressure sits with power-hungry developers, weak utilities, and data center projects where grid delay or security risk turns growth into cost. For private investors, the takeaway is that the AI trade is no longer only chips versus software. It is also power, permission, and resilience. Third, Asia is giving Europe a funding discipline warning. CNBC reported that Alibaba plunged after announcing a $10.2 billion share placement to fund its AI push. Investing.com reported that Asian stocks sank as Samsung and Alibaba led a tech rout, with Nvidia and the Fed in focus. For Europe, that makes the semiconductor chain more selective. The cleaner side is ASML, ASM International, and B Semiconductor if CapEx still converts into high-quality orders. Pressure sits with weaker AI labels and hardware names where investors fear dilution, spending intensity, or demand that is already priced in. For private investors, the filter is proof quality. AI spending can be real and still punish companies if funding terms, margins, or backlog disappoint. Fourth, the corporate map is also changing underneath the index. Investing.com reported that Shell's chemicals exit is drawing interest from Exxon and LyondellBasell, while MarketWatch framed U.S.-Canada trade tension as a futures risk. Europe therefore has to separate companies simplifying portfolios from companies exposed to tariff and supply chain noise. The cleaner side is businesses that can sell non-core assets, defend margins, and keep capital discipline. Pressure sits with cyclicals that need smooth trade, cheap energy, and China demand at the same time. For private investors, the practical takeaway is to watch balance sheet and portfolio quality, not only the index level. Here is the stock-led watch list. First, Shell, Total Energies, and BP. Does Iran risk support energy cash flow or become a wider inflation tax? Second, Lufthansa, IAG, and BASF. Do fuel and feedstock costs pressure margins? Third, Schneider Electric, Siemens Energy, and Legrand. Does AI-powered demand become orders or grid stress? Fourth, ASML, ASM International, and B Semiconductor. Does Asia's AI spending still reach Europe's suppliers? Fifth, SAP, Siemens, and Nokia. Do software, automation, and network names show proof beyond the AI label? Market bias. Europe can open selectively constructive, but only if energy risk stays contained and AI infrastructure names show real order proof. The mistake to avoid is treating lower oil, AI demand, and tech funding as separate headlines. Today's market is about conversion. Which companies can turn the story into cash flow without taking on too much cost, dilution, or balance sheet risk? That is the Europe Morning Market Brief for Monday, 24th August. Watch the proof, not the label. Research context only. This briefing is not investment advice, not a trading recommendation, and not personal financial guidance. No price targets, stop losses, position sizing, or portfolio instructions are provided.